Hello, Gowinvest peoples. It is Sobi Kenobi here with another lesson of Gowinvest 201, where we're still talking about options trading. Today will kind of be a short lesson talking about intrinsic and extrinsic value and all the factors that kind of play a part into that, and really understanding what this three-dimensional projection of the stock market is, and understanding how it can greatly affect your portfolios. Okay guys, so lesson 2, intrinsic and extrinsic value. Okay, so what we're talking about here is, say you had those contracts. You have the stock price, you have the contracts that go up, and you have the contracts that go down. Alright, the contracts that go down, we talked about it last time, were called puts. Contracts that go up are called calls. Okay, so what is, to understand intrinsic value, let's talk about this first because this is the easier one to understand. We just have to understand in the money, so ITM, in the money, our OTM, which is out of the money. And really what it is say you had a strike price for the 27s for your calls, or 27 for your calls, and the value was going up to 27.50. Okay, so your strike prices were $27. Right now it is the current price is this, so this current price is greater than your strike. Okay, thus therefore it is in the money. Okay, simple concept. If you buy it when the price is $25 and you buy the 27 strikes, 27 is less than 25, which is the current price, so it is out, OTM, out of the money. It's very simple to understand. Basically, if I was to expire, this contract was to expire today, it'll be worth something, or it'll be worth nothing, if it expires today. So that's the in the money, out of the money connotations for stocks, for on options contracts. So you'll hear that certain things are in the money and certain things are out of the money. The in the money things can do something interesting. They can be put towards credit, and that gives you a credit for maybe selling some shares, selling contracts. So you can sell contracts based off of your in the money options. So if you buy something that's in the money, you can sell as a basis of that and not receive a lot of risk. So it's almost as good as if you had the shares, if you're in the money. Out of the money, it's just really speculation. So you have a whole lot of speculation. But then it comes to you that, why, if I was trading at $25, why is the $27 still worth like 0.2 cents, 20 cents per contract? And then I'll have to pay basically $20. This would be per share, and this would be per contract. Remember, a contract is 100 shares. So why am I paying $20 for this? So this $20 is extrinsic value. An extrinsic value consists of time decay, which is your theta. We'll talk about this more when we get to the Greeks, but you have a time decay. And that's the closer you get to expiries. I think we talked about this a little bit. The closer we get to the expiry, the variability over here is wide, the variability narrows. And that's why we have less extrinsic value. The other things is implied volatility. And this implied volatility, it's kind of hard to understand, but it's really easy to look at. IV is implied volatility, not intrinsic value. Both of them have IV, but IV is implied volatility. And what it is it's the bid and asks for that contract. It checks out the volume, and it does some other things. So say there were some news plays or something like that, it does a calculation between the bid and the ask sizes, and it sees that, look, there's a lot more buyers, there's a lot more sellers. Say before some news play, implied volatility is crazy. So this extrinsic value for the contracts, extrinsic val for the contracts is pretty high, because there's a lot of people trading it, and some people might trade it for a higher value, some people might trade it for a lower value, and basically that variability is pretty high, and thus our extrinsic value, or what it's worth, potentially could be very high. But as soon as the news play happens, then people understand that it has a certain value, or it narrows the bandwidth of where the ideal value would be based off of maybe technicals, as it's maybe a second degree motion. So everyone thinks that, okay, the new stuff has already happened, so there's nothing new coming out, so let's just sell. And also fundamentals. So you might have some earnings per share, or return on assets, or something that motivates that, look, this is how much the company is making, this is how much each share should be valued at, and from that point onwards, it kind of trades within channel. So your implied volatility goes down. That is called an IV crush. So if you ever heard this term, this is your implied volatility crush. This is why you should never trade options as just before news play and sell after. In our case, it wasn't this. We were already playing on low implied volatility, but it just somehow kept going down. Now, so that's the extrinsic value side. It has a lot of to do with the actual sizes of the bids and the asks, and very current factors, or plus expiry. And if you can get those two factors together, you got the extrinsic value of the contract. The more hype something goes up, say everybody's betting on GameStop, then the extrinsic value of both the calls and the puts go up. And you can see that by maybe a Bollinger Band. If I did a Bollinger Band for, like, let's say Tezos, I just have that over there just because it's something that I kind of look at every once in a while, but I was invested in there. But say you get the trading view and we give the Bollinger Bands, you can see how even though this fell, the implied volatility both increased on the top side and on the bottom side. So that is that's why implied volatility increases in both directions, and that's why extrinsic value is pretty high even in those cases of big movements. So to think that, okay, this went up so much, I'll just get a put option. No, the demand for puts is higher. So so IV, our implied volatility is higher, and extrinsic value is higher. And so you will still be paying a premium for those puts, and the chances of it falling down that much would almost not be worth it. So these are the two things you have to consider: intrinsic and extrinsic value. For an option, intrinsic value is very sustained. You might be like, it's the actual value of your contract, if it was to expire today. So that's what we worry about more so. We prefer the intrinsic value, but we can also, if it has high extrinsic value, you can sell right away. Sell it. It's not worth holding something with high extrinsic value and risking time decay. So it's best to, if you have a higher extrinsic value, let's say if this should be 75%, maybe this should be 25% extrinsic value. But if you see some sort of ratio over here where extrinsic value is way more than the intrinsic value, that could be a good indicator to sell. Basically, we'll do some calculations on this. I haven't run the numbers, so I don't know exactly if this is the right position to sell to maximize your profits. But you want a ratio of intrinsic to extrinsic value, where intrinsic is the more important thing. The extrinsic is the hype factor. It's very it should play a low part in your purchase of an option unless you're planning to gamble. So next week we'll be talking about the Greeks, the delta, the gamma, I think it's like this, the theta, and your theta and vega, as well as rho, maybe. I don't know. This really just is interest rate. But we'll talk about these next time. Alright, see you guys later. That's today's class.